It's never great when you've been public on a big call like Tesla and the first quarterly result after is 20% short squeeze. But look, for us it doesn't change the thesis. It fits beautifully in our portfolio of against some of our US mega cap long investments that are cash earners and highly cash generative. Tesla is burning a lot of cash, so even though they did squeak a profit during that quarter, they've still lost $1 billion year to date, aren't generating any cash, and we had some questions about the quality of that result. So painful in the short term, but still plenty of time until the end of 2020 when the Livewire sort of clock stops.
How does the, I sometimes think about this with short positions. Do you have the same endurance? Do you give those ideas the same amount of time to play out because there is a cost associated with holding that position?
Yeah, I think you do have to expect going into it that it'll take longer for the market to wake up to what you're concerned about than you might expect from the outset. So I think John Hempton's got a good line about, you have to be prepared for that fraud to 10x on you on the upside, and that's why position sizing is really important with short selling, and why we run twice the number of shorts in our book as we do on long, so that when you inevitably get one wrong in the short term, we have constant bids for stocks or short squeezes in our short positions. The position sizes are manageable enough that we can wear that volatility, and hopefully if you've been sensible, you might even get a chance to add to that short after that short-term squeeze plays out.
So they're relatively smaller positions, just more of them?
Yeah, our biggest short would be close to a 5% position, which is very big. Our biggest longs can get up to 15, but typically sit at around the 9 to 10% level. So, rule of thumb is on average our short positions are half the size of our longs, and we often have twice as many short positions as we do longs.
Well, it's a bit of a snapshot, Tesla, because it was topical. If we can dial it back, because some people may be familiar with Totus, others not so much. Just from your own perspective, what was the starting point in investing? What was the first experience?
Okay, yeah, certainly started out long investing like most people. Back at uni, there was, I've talked about this in previous podcasts, there was a little gold stock called Carpenter Pacific, which got involved with some, money I'd earned through part-time work, and my dad had never invested in shares, and we bought those shares together. And I can't recall exactly the P&L, but my feeling is that it was probably okay because we kept at it. Had a look back at the price chart a few weeks ago, and there was a little blip in the gold price, and that's probably why we were focused in that sector back in those days. But I noticed the ticker and the name of that company had changed over the 20 odd years since we started playing around in stocks, and that is now a Flamingo AI company trading at about 0.2 cents a share. So it shows that
a Flamingo AI.
That's the name of the company. It's the ticker has changed from Carpenter Pacific to Flamingo AI. So just another reminder that non-renewable companies like resource companies, it's difficult to put them in the bottom drawer and buy and hold them forever. There's a time and a place to own or potentially sell those kind of stocks, and we don't do a lot of long investing in those type of companies these days, and some of them were probably due to those early lessons.
Yeah. So your experience professionally as an accountant, you've now gone into funds management. When it comes to investing and how you describe what you do at Totus and your philosophy, who and or what have been the big influences, and how have they influenced you?
Okay, I was lucky enough to work in the sell side of the industry for 7 or 8 years prior to moving to the buy side, and I had a lot of great clients that had all sorts of really well thought out and different ways of investing, and I think I was attracted to those styles of investing that had the ability to perform regardless of what was going on in the market, because when your mortgage and kids' school fees are entirely dependent on an industry that can be cyclical at times, it's nice to sort of know that your part of that industry has potential to survive the inevitable rough patches. So I like the idea of not necessarily investing with the index, but going to a part of the index where something was happening, whether it was a headwind or a tailwind. And my experience over the years was that we saw just as many poor companies as we did good companies. There's actually a lot more poor companies, numerically out there, and that there was good opportunities to be made if you could balance out a portfolio of really high quality good companies with some lower quality poor companies over time. So I did work for a bloke called Phil Mathews many years ago who loved that idea of focused investing, ignore the index, put your money in your best ideas. And we've tweaked that significantly to be diversified across themes and companies, both on the long and short side. But that was a big influence. And then I've got to throw in the old Warren and Charlie, like all managers that have had any longevity have really come back to that sort of style of proven business models on the long side with high quality management that understands what they're doing on the capital front and buying businesses at a reasonable price.
Mm-hmm. Now you've got you sort of talked earlier about shorts being quite small and more numerous in terms of their position size. You told me the other day, which was news to me, that you've got a ultra concentrated long only portfolio as well, which is sort of 10 to 15 stocks go anywhere. What's the rationale, and can you give me a sense of what sort of things are in that?
Yeah, well, maybe it's maybe we're ringing the bell on the market there with a fund that we've done a lot of shorting over the last 7.5 years, sort of opening a small high conviction long bias offering. But there's a few reasons that we think it might be of interest to our existing clients and maybe a small group of external clients. And that's because having spent a lot of time looking at low quality companies with problematic business models, corporate governance, red flags, aggressive accounting, our long book has tended to be extremely clean, boring, cash generative, a lot of alignment between management and shareholders. And the performance out of our long book over the last 7.5 years has been very strong in the Alpha Fund. And we formalised a strategy with our best ideas from the long side of the Alpha book, and it was managed by my co-PM Sam Granger. We've been incubating that for 5 years now, which is a long time, and the strategy's done really, really well. It's produced about 15% returns net of fees over that period. So we're doing a small offer to see if some of our investors that had a good experience with Totus when it was small in the Alpha Fund would be interested in that kind of strategy.
Yeah. So concentrated, what does that mean? How big do positions get? And what sort of stocks do you want to put into it?
Well, there's 14 stocks in the portfolio at the moment. It's maximum of 15. We've got a hard limit of 20% of in any one stock. So it's a high conviction fund, but not an all eggs in one basket fund. What we liked about that strategy and why we thought it might be of interest is that it's been able to generate those good returns with a much lower gross exposure than the Alpha Fund. It's carried about 30% cash levels since inception, so the risk-adjusted returns have been excellent. And also with a small amount of capital, you can sometimes own a bit more of stocks, in a $5 to $20 million fund than you can in a $250 million fund. So there's slightly different weightings. All of the stocks that are in the high conviction fund are in the Alpha Fund, but there's just slightly different weightings. So the kind of, the key thing we're looking for from businesses there, strong defensible businesses with sticky customers and moats that don't require a lot of capital to grow. Then we're looking for management that have a good track record of doing what they say they're going to do and allocating capital. And then the third thing is a reasonable price to enter those. So it's a very high bar for that fund. We don't find too many companies each year that fit that criteria, and that might be part of the reason why it's done well.
I'm dying to know what's in it now. Can you pitch me a stock? So can you talk me through something? If that bar is so high, Can you talk me through an idea that's made it into that concentrated portfolio?
Yep, it's a slightly different beast. It's got Aussie mid-cap stocks and global industry-leading mega-cap stocks, so it doesn't fit easily into an asset allocation bucket. But in the Aussie mid-cap space, the one that we really like and is the largest position in that high conviction fund is Objective Corp. So that is a database software business that sells into the government, and the things we like about it is that it's migrated its business model to recurring, earnings from perpetual license model to recurring earnings. The second thing we like about it is that it's very conservative in the way that it accounts for its earnings. It's probably the most conservative stock in the Aussie software space. It expenses all of its R&D, and its free cash flow has consistently been about 20% ahead of reported profits. The last thing we like about it is management skin in the game. The founder, Tony Walls, has over 65% of the stock himself, and he's managed to reduce the share count by about 30% since it listed a number of years ago. So you've got, good capital allocation track record and alignment, a really nice defensible earnings stream, and a price that certainly doesn't, it has run of late, but certainly still looks quite reasonable, particularly relative to anything else on offer in the Aussie tech space. Just
taking a step back from the micro at the stock level a little bit, I've been talking with my business partner about what are the biggest consensus views that are out there. And one of the things that I've noticed is starting to get written into articles and reports as a given is that we're late in the cycle. And it's sort of become part of the lexicon that given that we are late in the cycle, we have XYZ view. We've seen of late a number of IPOs try to come to market and have been rejected by equity markets, and it struck me that that's sort of a sign that things are actually really quite rational, and you have this sort of pervading sense of, the narrative is a bit bearish, we're late in the cycle, you need to be cautious. I look at a few things like that and it makes me kind of question, well, why can't markets continue to rally really healthily for a period of time when you've got that narrative that, we're definitely late in the cycle, that is fact, and you're seeing markets behaving in a pretty rational sort of way.
Yeah, I hear you, James. We're not 100% sure that it's end of cycle. It feels late cycle to us. But investors we talk to talk a relatively bearish or conservative game in terms of favouring cash levels and alternative investments. So maybe things can continue for a bit longer than people think, but there's a few canaries in the coal mine out there. We've had some of these very cash consumptive businesses start to experience hiccups in the market. Offshore, WAAAX obviously highly topical these days with the collapse in the valuation from the private market valuation, but Uber and Lyft and Peloton and a number of these unicorn stocks offshore. So late cycle, you can see the market start to wake up and start to discern between the really good businesses and those that are just growing because someone's giving that management team $1 and is happy to take 70 cents of earnings back, down the track. Before previous busts, you have seen spates of, big high-profile companies blowing up. It was Lehman and Bear Stearns in the US before the 2008 crash. We had Allco, ABC Learning, Babcock and Brown all start to experience problems before the broader market hit issues back here in Australia in 2007. So yeah, I think you just want to be alert but not alarmed, and remember that when the cycle turns and the music stops, it's going to be very difficult to change course quickly. When markets are down 10 or 15%, you're likely to be stuck in the chair that you were in when the music stopped, and just thinking that I'll allocate to alternatives or cash or high quality businesses when the market turns is probably overly optimistic.
To think that you have the time and the foresight to make that switch?
Yeah, we've got a lot of clients that have us on a watch list for when markets get more volatile, and I very much hope that they have the conviction to switch towards us, but when markets are down 10, because it's very difficult to know which is the market that's down 10 that's going to go down 30, and which is the 10% down that you need to buy the dip. So we just think it's sensible to have some alternatives, some shorts, some cash, given some of those orange lights that are flashing in the market. But you're a fundy, you've got to have a view. Do you, I mean, if you were to take the glass half full, glass half empty style analogy, what's your take? Are you more glass half full? Are you finding more long opportunities or short opportunities at the moment? Well, we've had a relatively low net exposure through 2019, which hasn't been the right call given how strong markets have been. We've managed to hold our own with a few targeted shorts, and our longs have done okay, but the shorts have in general been a drag on our performance. Look, the reason for that is that we're finding it difficult to find those good high quality longs at reasonable prices given how late in the cycle we are, and everybody is very aware that rates have been low rates have been good for valuations, but I'm just not sure it's as good for the economy in the medium term, and we're talking about this, James, in early November, and in the last couple of weeks we are starting to see the gild come off the lily in some of these very high PE stocks, both in Australia and the US. You've had Afterpay and WiseTech, down relatively hard in recent weeks, and then in offshore you've got some of the market darlings like Atlassian and Shopify are all well off their 52-week highs. So maybe that low rates stocks go up to infinity narrative is starting to get challenged already. Yeah, I think to your point, the other thing that's interesting is we're just coming through bank reporting season, and we've seen Westpac has had to cut its dividend and raise some additional capital, which points to the fact that the low rate operating environment is getting harder and harder for them to create that margin that they need. Yeah, I mean the banks are the plumbing of the economy, right? And credit is the lifeblood of the economy. So if your plumbers are doing it tough and having to lay off staff, it might not necessarily be a great thing for the economy down the track. So banks all do look pretty hard to us, and when you've got banking industry greats like David Morgan on the front page of the AFR saying, look, expect dividend cuts, expect capital raises and job cuts, he was last week he was spot on. In terms of breaking down the universe of investment opportunities, you think about things in buckets or themes. I was wondering if you could pick one or two of those buckets and sort of explain how it works. I'm guessing you're generally looking for industries that have got some really positive structural tailwinds. We've talked about some of the challenges in the broader economic environment. So maybe talk me through one of the buckets and what's attractive to you about it, and the sort of ideas that you're finding in it. Yeah, the topical one at the moment, it's very broad, but that theme of cash earners and strong balance sheets and businesses that don't have a lot of competitive pressures, so that the benefits of their growth actually flow back to shareholders in the form of dividends or buybacks. A lot of stocks on the long side of our book fit into that bucket, and then on the short side, businesses that are heavily reliant on external capital to fund their growth or even fund their existing operations have been a big focus for us, and also companies that have stretched balance sheets, because all of our best shorts over the last 7.5 years, the ones that go down 90% and don't come back, are generally those ones that need access to external capital to grow. And then when there's a hiccup, whether it's a loss of confidence in their business model or a broader market sell-off, they're the ones that really give you the protection when markets crash. So we've got a lot of those types of businesses on the short side. And we're finding those cash generative businesses, a lot of those really good ones in the US with well-established business models, deep moats, strong balance sheets, good capital returns to shareholders. So the big tech, for example, Apple, Alphabet are both doing massive share buybacks. Even Berkshire is talking buybacks again after their results. So Yeah, they're two. That's a bucket, long and short cash earners over cash burners, which is big in our portfolio at the moment.
You've alluded to the valuations in some of Australia's high-tech growth companies being pretty stunning and high. I don't want to pass judgment myself on the businesses. A lot of them have had a lot of success. We're talking about the WAAAX stocks, so WiseTech, Afterpay, Appen, Altium and Xero. Given that you do both the long and the short side of things, and you have this focus on the cash burners and the the cash earners and the cash burners, thought it might be a bit of fun to get you to go through the list and put them in order of what you think are the highest quality, first to last, and give me a bit of a rationale on each one and why you're picking it where you are.
Yeah, it's topical because we've been to the US recently talking to clients, and the only stocks we get asked about in the Australian market are the WAAAX stocks. So it's a good question.
And what do they want to know?
The Afterpay is the one that everybody is talking about. We actually had a fund reviewer that had been at a conference in Connecticut the day before, and 3 large US hedge funds had put Afterpay as their best idea and presented it to that conference in the same day. It was the only Australian stock we got asked about in New York when we went and saw investors in July. So I don't know if that's a good thing that there's...
Were people excited about it?
Yeah, wildly bullish. Now, I don't know whether that's a good thing because it's now crowded and everybody's very well positioned on the long side, or...
You could have said that about Afterpay at $10, at $15, at $20.
And some of these funds are massive, and growth funds globally are massive. So potentially things can get pushed a long way. But yeah, the WAAAX stocks are topical. So look, if I was forced to put them in order, Xero we own. So Xero's got to be number one in terms of our pick. We like the recurring earnings nature. We use Xero in our own business. We used to use the competition, MYB. Very sticky customer base and lots of optionality around what they can do with their customer base over time. So we like Xero.
The valuation's a bit of a, because you see the PE get presented with sort of 100 and something.
Yeah, I mean, what we like is that they haven't been wildly reliant on external capital to fund their growth. They're sort of almost at the point where they're growing within their own means. So. Yeah, I think the Xero is the one where we can see the long runway in the UK and the US, governments mandating more data or financial data to move online. So there's good tailwinds there. You're certainly paying up for it, but at 11 times sales, it's not as crazy as some of the others in the WAAAX stocks. So I'd put Xero as number one. Afterpay is probably the other one that's got, you have to hand it to the guys of how they've executed. They've done an incredible job and is clearly the best business out of the buy now, pay later space. And there is big tailwinds for that longer term. Now, I'm less sure about the valuation and what happens if we have a tougher market environment. So that's, I do have a couple of question marks about Afterpay, but I think they've executed really well. So Afterpay would be number 2. Altium would be number 3. Great business, just really, really expensive. And then further down the list, we'd probably put Appen, which is also a good business on a very high PE, but we can see some competitive threats down the track. We think their last acquisition looked really defensive. So I think that is less of a defensive business model over time, and you've still got the very high valuation. And then sort of right at the bottom, we've got WiseTech, which has been in the press, but they have come back to market a couple of times since listing to pay out earnouts and fund their growth strategy, which is heavily tilted towards acquisition. They do have organic growth, but their growth is is also acquisition intensive, which is also capital intensive. So roll-ups have been, a happy hunting ground on the long and short side for us over the last 7.5 years. So WiseTech probably slots in there at the bottom.
A couple of questions just to finish up on. Is there anything at the moment that keeps you up at night?
Apart from our 18-month-old daughter, we're in a good place as a business. We've got a really great diversified client base. I think the businesses that we own on the long side, we've through experience learnt that those cash generative businesses with conservative accounting and management skin in the game, they might sell off in the short term, but they do tend to bounce back. Our shorts can occasionally squeeze on us, but those businesses do tend to underperform, over the longer term. So as long as we've got customers that understand our process and are able to stick with us through, short-term volatility, I don't lose too much sleep over our process, but we do sweat the downs. No, I think it's just generally a very regulatory and compliance intensive industry these days. So we've got an awesome COO. So just making sure we're well invested on that front, and try and enjoy it.
Final one. So you've got an 18-month-old daughter. She turns 18 and says, "Dad, I'm ready to go put some money in my ComSec or my NAB account, whatever it might be." And she says, "How should I get started?" What do you say?
It's a good one, James. Look, unless you're really passionate about it, I do think finding some people you trust that have, you can buy into their strategy and the way that they make money longer term is a good way to do things. Some low-cost index funds is also not a bad idea, and just not putting all your eggs in one basket. Look, I'd be thrilled if she was interested in investing in shares, but if she wants to be, a gardener or a nurse or whatever she wants to do, that's just fine with me. So I would say, unless you're passionate, find some people you trust with a proven process and get to know them and maybe start allocating gradually over time towards them.
Great. Well, thanks for coming in, and thanks for having a chat.